Welcome once again to our accounting classroom. And today in our accounting lesson, we are going to just take a short look at partnerships and their financial statements. So this is a basic introduction to partnerships. So let's talk a little bit about partnerships. Now, what is a partnership? A partnership is basically an entity where there are two or more owners of the enterprise coming together for a common goal, and that goal is of usually making a profit. Now, these partners are usually governed, or the partnership is usually governed by the law given under the Partnership Act of 1890. So there is an act which governs partnerships and which details what should and should not happen within a partnership. Now, what are some advantages of a partnership versus a sole trader? Because we can look at partnerships and compare them to sole traders. We can compare a partnership to a company and look at the similarities and the differences between these different types of business structures. So let's look at some advantages and disadvantages of the partnership over the sole trader. Now, for one, the risk is spread across more people. So you have more persons to share the burden of debt or to share the liability that would occur within the business. Two, there's more money and resources can be provided. So in other words, since you have more persons, you can have more capital injected into the firm, and you can have more resources coming into the firm because you have more people to contribute to those resources. Also, you can have more skills and expertise can be provided by the increased credibility with potential customers. And so the more skills and expertise that we have, it can provide increased credibility with potential customers and suppliers. So when you have a partnership, you get more skills coming into the firm. You get more expertise coming into the firm. Because if you have a sole trader, it's just one person. So that one person is just basically bringing their own skills, their own knowledge, and there's nothing else. That's all that they have. But the more people you have within the firm, all of those different persons have different skills, different expertise, different levels of knowledge, and all of that can be beneficial to the firm. And since it's beneficial to the firm, it will also increase the credibility of the firm with their potential customers and their suppliers. Now, a few disadvantages of a partnership over a sole trader. And what I would like you to note is that you can also do additional research to find more advantages. These are just a few that I would have mentioned, but you can come up with more advantages of a partnership over a sole trader. Like for example, another advantage could be that the fact that the person doesn't have to share the loss themselves, which is the same thing as spreading the risk across people. So like if their loss is one person doesn't have to bear all that burden of the business not making a loss, that loss can be shared across the other partners. Similarly, with disadvantages of a partnership, you can have more than what I may mention, but you just have to do additional research. So like a disadvantage of a partnership over a sole trader is that profits must be shared. So if you have a sole trader, which is an individual person in a business, that person takes all the profit, whether if it's $100,000, that all the profit is going to them. But if you have a partnership and the profit is $100,000, that $100,000 has to be shared among all the partners. So that could be a disadvantage of a partnership over a sole trader. Another disadvantage is that there's less control of the business decisions. Obviously, because you have multiple persons within the business, so therefore you have differences of opinions right? And you have this limited control. So you have less control of the business decisions. There can also be dispute over the workload, wherein persons may be thinking, um, I am doing more work than the other person, or you are doing less work, but you're getting more profits. So you can have these disputes over the workload within the business. Another disadvantage is that you can have problems where the partners disagree on the direction of the business, because one person may want to expand the firm or expand the business and take it international. Another person may say, man, no, that is too fast, it's too soon. Let us stay local. Let us go in this direction. So you have this like a tug of war among partners, and they're disagreeing on the way forward for the business. And all of these things could end up being detrimental to the firm of itself. So these are a few advantages and disadvantages of a sole trader over a partnership. Now, a partnership usually comprises of two, obviously, because one person cannot be a partner. It's a sole trader. So the minimum, it will comprise of 2 persons to a maximum of 20 persons, with the exception of some firms. And banks usually have a maximum of 10 partners. Now, in our local environment, we have a lot of small businesses and sole traders along with partnerships. So you have the accounting firms, whether they are large accounting firms, medium size, or small accounting firms. You have attorney at law, you have real estate, you have engineers, and you have a different set, these dentists, doctors, all of these people could be in partnership. So these businesses are different types, or these professions rather, are different types of partnership that you can have. You can have the accounting, you can have the lawyers, you can have dentists, you can have real estate, you can have doctors, you can have engineers. All of those are different types of partnerships. Now, a partnership is normally set up using a deed of agreement, which outlines the conditions to the partners. Now, agreement can be either verbal or written, but it's preferable that this agreement will be a written agreement. So we're going to talk about some of the things that should be included in this agreement when it is drafted. So this agreement should include the amount of capital each partner should introduce at the start of the business. So it should state how much capital you think that each partner should be introducing at the start of the business. It should also state how the profits or losses should be shared among the partners. And additionally, it should state if there is a guaranteed share of profit going to a particular partner, because that is something that can occur where you say to one partner, we are making sure that the minimum profit you take home is X amount per year. And sometimes some firms do this where they guarantee a share of profit to a partner, because they want to encourage the partner to be a part of the business, because this person may have some special skills, some special knowledge that the firm may need. So they want to do what is best, or what they think that they can do to make sure that the person join their partnership. So they may do so by guaranteeing to that person the minimum profit they can take home per year, and this should be stated within the agreement. Additionally, if there is interest, if partners take drawings, then and you're planning to charge interest on drawings, then that rate of interest should be stated within the agreement. Also, the rate of interest that you are going to grant partners on the capital that they invested, that should be stated in the agreement. And again, that is if you decide that you are going to grant them interest on capital. You state the rate in the agreement. You should also state if partners are going to be granted salaries. If they're not granted any salaries, well, it is not in the agreement. But as long as you're granting salaries, you state that in the agreement. Also, some partners can give a loan to the firm. So if a partner gives a loan to a firm, then you should state within the agreement what is the interest rate that should be paid on that loan from the partner to the firm. And if you do not state a rate, then the rate is 5%. And this 5% is according to the Partnership Act of 1890. This is what the Act states. This Act states that if you do not state an interest rate in the agreement, then the rate is 5% on any loan provided by a partner to a business. And when we talk about this loan, we are not referring to a loan from a financial company, a financial institution. We are talking about the partner granting or giving a loan to the firm. Okay, that's what we're referring to. Also, the deed of agreement should also state any arrangement for the admission of new partners to the firm. So you may want to bring in somebody new. So therefore, if you are bringing in a new person or new persons, the deed of agreement should state and outline how are these new persons going to be admitted to the firm. Under what conditions are they going to be admitted to the firm? Additionally, it should also state what would happen when a partner retires or a partner dies. How are we going to deal with this situation? How are we going to dissolve? How are we going to divest the assets, etc.? What are we going to do if a partner decides to retire from the firm or if there's a death of a partner? So all of this should be outlined in the deed of agreement. So we have to recognize that with a partnership is normally set up using a deed of agreement which outlines the conditions to the partners. So we will take a brief break and then we will come back and we're going to discuss a little bit more about partnerships. We're going to talk about when there is no agreement. What do we do when there is no agreement? And that goes to the Partnership Act. We're going to talk about fixed capital account, fluctuating capital accounts, and current account. We're going to talk about the format of the appropriation account. Those are some things we're going to discuss when we come back in our next video. So see you then. And in the meantime, we want you to like this video and subscribe to this channel.